How long should you fix for? 2 years, 5 years, 10 years? The key is start with life first, your work, family, and plans, then use price as a signal, not to see the future. So banks can be profit driven. Their pricing can be aimed at nudging client behavior. If a 2 year looks materially cheaper than a 5 year, that could be a clue, but it should never be the only reason you choose that option. Quick reminder before we start, this is general information, it's not personal advice. I have to remind you, all lenders assess criteria differently and affordability depends entirely on your own circumstances. Your home may be repossessed if you do not keep up repayments on your mortgage. All right, let's go through this and help you to make a decision as quickly as possible about whether a 2, 3, 5, or even longer suits your situation best. First things first, a mortgage is entirely about you. You need to begin with your personal circumstances at the heart of your decision. That means thinking about things like, are you likely going to move, or do you just want the flexibility to decide that? Do you want to upsize? Do you want to downsize? Do you need flexibility for a new role you've been looking at? Is your business having heavily investment or family looking to change in the next 2 to 5 years? If you expect a change inside 2 years, then a 5 year fix can be entirely restrictive because of early repayment charges. If you plan to stay put for 5 years or even longer and you value certainty, then a longer fix can earn its keep by stabilizing cash flow, reducing admin, and just taking away the stresses of watching the market when you get close to your fixed rate ending. So make a checklist and answer some questions such as, how stable is your role at the moment? Do you have any potential for relocations? Do you have any clear family milestones you're aiming at? Is your health changing? What's your appetite like if payments go up or down? Could you sustain it? Could you not? Write the likely horizon in months, and that line guides pretty much everything else. So here's the mechanics. A fixed rate product locks your interest rate for a set period of time. Common options are 2 and 5. Sometimes you can get 3 years, 7, or even 10 years if we're looking longer down the line. During the fixed rate, payments are predictable. You know exactly what you're paying month to month. If you leave early, you'll usually face what's called ERCs or early repayment charges. Shorter fixes mean more frequent remortgages, potential for higher fees. Longer term fixes mean fewer admin cycles, but a lot less flexibility. So the next section, we need to look at the impact of interest rates. And we have to treat lenders what they are. They generally are profit motivated businesses. Pricing can be a signal of how they expect to earn a return and how they want to shape demand in the market. For example, if a 2 year fix is materially cheaper than a 5 year, you have to ask yourself, what are they signaling and what information do they have? It could imply that they see value in you resetting sooner via remortgage or a product transfer, where they can reprice or earn fees again. Conversely, when the 5 year is cheaper, that could signal that the lenders may prefer you to commit longer, possibly reflecting their funding costs or views on future rate paths, such as the Bank of England base rate. Now, it's important to note, whilst that is a good indicator, it's only a helpful indicator. It's not an oracle. Markets change, they go up and down. So use it to pressure test your choice and your ability to sustain increase or decreases in rates. But importantly, do not use it to make the choice entirely for you. Fit it to your personal circumstances. Choose the shortest fix that comfortably covers your expected stability window. If your likely horizon is 36 months, a 2 year may just be too short. A 5 year offers headroom. So we need to look at total costs, or what we like to call true cost. So we need to compare the total cost of ownership over the fixed rate or the relevant period, not just the headline rate. So include product fees, any legal costs, valuation fees, any ERCs if you're likely to trigger those. 2 short fixes can sometimes cost more in fees than one longer fix, even if the rate looks lower. It's also important to take into account flexibility features as well, overpayment allowances, portability if you move, early repayment structures, trying to maybe prefer some that have a sliding scale versus a flat percentage of the outstanding balance. Make sure the deal lets you handle the most plausible what ifs. Then we have to look at what I like to call the price gap test. Look at today's spread between a 2 and a 5 year for your profile. If the 2 year is only marginally cheaper and you value stability, the 5 year can be a rational decision. If the 2 year is significantly cheaper and your life horizon is short, that can tilt you more towards a shorter fixed rate, as long as you're comfortable with the risk of higher payments when you reset. Either way, let your personal lifestyle and your personal situation be the decision maker. Here are a few examples for you. We have a young family whose expectations that they're not looking to move anytime soon. They've just bought their forever home. Childcare costs, they're worried about peaking. Overtime's a little bit unpredictable right now. So a 5 year fix for these often suits. You have fewer remortgages, clearer budgeting, and you can still overpay if your allowances allow it. Another scenario, you could have a director with a relocation risk in the next 18 to 24 months. 2 year fix for this director might give him a few more options. If 2 year pricing is materially lower, it strengthens the case. But you have to still check the ERCs, fees, and if portability is still an option. Another example, a first-time buyer. They're expecting promotion in the next couple of years. We could consider a 2 or a 5 years, but if the promotion likely brings a big pay bump, shorter can let you restructure the deal sooner, give the option to upsize if they want to, but if certainty is paramount, 5 can radically reduce stress, and we have to weigh up the fee cycle of remortgaging more frequently, carefully, and match it against a 5 year. So here's a couple of common missteps and mistakes that I see quite common in my job. The first one is chasing headlines. Picking rates purely on lower displayed rate, then paying more in fees after a couple of years. Ignoring early repayment charges, so that's moving or overpaying heavily and discovering what that penalty is later. And then we have what we call forecast worshipping. That for me is listening to either friends, family, or somebody else online and building a plan based on someone else's rate prediction. And remember, we have to always use price as a signal, not as certainty. Then finally, we have to summarize it all onto one page. So write down, what's your stability horizon looking like? What's the shortlist for the total costs? What likely fees are there going to be? Are there any flexibility features that you can't live without? What's the current 2 versus 5 year price gap? If your life horizon and the price signal point the same way, that's usually your answer. If they conflict, default to what your lifestyle needs first and buy flexibility where you can with things like portability, lower early repayment charges, or higher overpayment limits. The key thing here, there's no exact science. Start with what you need first, then look to read the market signals as an additional extra. It's a smarter way to choose, and that keeps you in control.